Hello, my fellow Bitsgapian traders. I hope you're doing well. So, welcome to our new webinar about using futures trading within the Bitsgap platform. In this webinar, we'll be getting into the details of, what is future, what makes future trading, what are the basic concepts such as leverage, margin, liquidation prices, the risk that lies on doing futures trading, and of course, into the available tools on the Bitsgap platform so that you can totally automate your futures trading with automated bots. So before we get started with this, I would just like to have a quick, really put some emphasis on the overall user security and user privacy and user fund security. Just keep in mind that all major crypto channels are targeted by ill-intentioned people who will pretend to be admins and support team. So beware about that. Beware of the fake profiles on Telegram and Discord channels. Things that you need to keep in mind is that real admins do not ever send any private message, either to welcome you or to help you online. So, just always validate that your private chat, the message that you're getting, validate it in the main channel, just to validate that whom you're talking to is a legit user, admin user. And the other point that you need to keep in mind is that, support is only provided on the live chat, on the bitsgap.com application or website, or using the support@bitsgap.com email. So that being said, let's get started. So we'll be digging into futures, what that means, what are the limitations, how the bot works, etc. Before we get started on the overall concepts, let me just put in some context around this. A lot of users want to do futures trading, but there are things to enable that. First of the things is that you can only do futures trading if your exchange allows you future tradings. That means either you're on Binance, on KuCoin, on Bybit, and you have an account that allows you to do future tradings. If that is enabled on the trading platform, then you can use a Bitsgap automated traded bot to trade it. But if you are not enabled from an account perspective on the exchange, it will just not work. You have to stick to just standard spot trading, automated bots, etc. So that being said, let's start digging into this. Well, we all know, the Bitsgap tools. We've been using them for some time now. Personally, I've been using it for several years. And depending on, the hype that's happening around crypto and Bitcoin and all the altcoins, there is a lot of potential for gains. And so it's all about being able to trade smarter and not harder. There are a lot of constraints in when you're trading. You need to understand some basic concepts of trading. What are the trading techniques? And for that, during my different webinars, we've talked about market structures, we've talked about the market phases, and I'll not dig into this one because I've already covered it several times. It's about the market trends, how do you identify a trend, what does a trend look like, and what are the optimal tools to use during those trends, the primary, secondary, and minor trends, and how to identify them, and what are the plays on those. These are things that I've already covered in several videos. So, support and resistance is a really very interesting thing that you need to be cautious about, because that is what is going to be driving all the price action. Support areas are areas where where new buyers will come in. And so that is a very strong support area. And I talk often about support and resistance areas when I do some technical analysis or when we're looking at what's happening in the market. So understanding support and resistance, these are really critical levels that you need to at least have a vision about. And that is important, especially when you're setting up your bots, either a grid bot or a DCA bot. You have to understand, what are the ranges that you're going to set. And we use the support and resistance levels to define that. So that is something important also. When you're investing, there are many tools out there. There are a lot of tools, different ways of doing. You can do manual trading, copy trading, earning pools, automated bots. There are a lot of tools, and there's a lot of differences in returns, risk, and expertise that you need. So depending on where you are sitting and the level of knowledge and expertise that you have in a given area, for example, technical analysis, then you can, pretty easily choose the correct type of tool that you're using. In our case, the most easy tools to use are the grid bots. Those are just passive earning tools that are going to be running endlessly, with taking out all the emotion from the user perspective, avoiding any bad decisions and things like that. So that's quite interesting. And as your level of technical analysis and expertise grows, then you can start moving toward more advanced tools. When we're looking at the portfolio from an overall perspective, there are different tools, and those are focused on different type of profiles and different type of users. We've got a lot of, in the crypto world, we've got a lot of newcomers. Every bull cycle brings in newcomers, so that there needs to be some sort of easy access. And there has been, setting up, automatic setting, AI-driven setups that are provided in the platform that help you easily start grid bots, DCA bots, things like that, very easily. So easy access for newcomers and new users. For more expert users, you can start moving into more manual trading, DCA bots, advanced configuration, future bots. Those are things that are going to be quite interesting also. We've done a compare on the different tools, the return that it brings, the risk that it represents. There is, the more risk you take on a given asset or on a given strategy, the more potential it has for returns and gains. And depending on the trend that you're sitting at, either uptrend, sideways, downtrend, those, each tool will have a different performance. So you need to understand how those tools apply on the different type of trends. A basic setup workflow that we always use, and that I personally try to set up when I'm doing my own trading, is about the steps that you need to cover from an overall analysis perspective. The first step is really about selecting an asset, which is having a basic understanding of why you are selecting a given asset. This can be proposed by scanners, and we'll provide some links for that. Review the fundamentals. What is the project about? What is it? What is a given coin? Is it just a speculative type of investment, or is it going to be a much more longer term investment strategy because you believe in the technology? That's the first step. So you first select the coin, then you start identifying primary and secondary trends, understanding where is it in this price action, how is it moving, and you're going to define your own time frame on which you're going to be willing to trade. That can be a daily trade, that can be a weekly trade, monthly trade, depending on the type of trading that you want to do. Once you have identified those main trends, what you start doing is really understanding these support and resistance levels. Once you have identified those those levels, you can pretty much decide what range you're going to be trading. And that helps you define a range for a grid bot, how many DCA orders you want to put in on a given DCA bot, for example, things like that. And once you've identified those level and defined the range that you're going to work on, then you start validating the volume and the volatility. These are typically provided. There are indicators. You can use them on TradingView, such as the ATR, which is the average through range. That gives you the range of change of a price on a given candle as an average. And that lets you define what's going to be your grid step, or what is going to be your DCA price grid percentage. So that helps you define how many transactions you would be getting in a given setup. Once you have defined and you've validated that, you move to the final step, which is setting up the grid or the DCA, checking the RSI, and basically trying to figure out when is the good moment when you want to get in, which is a starting point, and that will be provided by a given set of indicators such as the stochastic, the RSI, moving averages, whatever you're comfortable with, and what is going to be your ideal exit point if you want to exit once your defined trade is pretty much done. So this is a basic setup workflow, and it is quite interesting because it helps you define and move from step to step before getting into something. So we've got a grid strategy. We've talked about the grid strategy, and there's a full video around the grid strategy. We've got the DCA strategy, which is also quite interesting, which is going to be all about having an entry point, having some initial investment, and then adding additional DCA orders that are going to average your buying price and will allow you to make profit as soon as there is some turn from some upwards momentum. So that's quite interesting. And this DCA strategy that can be used on spot trading, and I've done a video on that also, which was a detailed view of how DCA strategy works with shorts and longs. What we can do is, pretty much move from here and apply it to future tradings. Now, future tradings is going to be the same thing. We're still trading an asset. Now, what makes the difference between future tradings and spot trading? Basically, what the main difference is going to be that you're going to be able to use leverage. When we are talking about leverage, it's about being able to invest only a small amount of capital and leverage that by borrowing some assets from the exchange that allows you to have much bigger bets. So the position is going to be much bigger than what you're investing, and that is typically with the borrowed funds that you are borrowing from other users or the exchange. So the way that's going to impact your trading is that the gains potential with leverage is going to be much more important. For example, if you have $100 that you want to bet on something or you want to trade, you could, using 10x leverage, you could actually be playing with $1,000. So if you make a 1% profit on $1,000, which is $10, you've actually made 10% profit of your $100. So which is quite interesting. The way this is going to work is from a platform perspective. As I said, if your exchange allows you access to futures trading, then you can set it up, and the borrow mechanism will be pretty much automatic for you. You don't have to worry about that. If you're using a given leverage, it will automatically borrow the funds in the background. The other thing is that when you're doing future tradings, is that it can be used, and which is quite interesting compared to spot, for example, where you can actually use them for long and short positions. Either term, it can be mid-term, low-term, short-term, or long-term. You can use it on sideways market, uptrends, and downtrends. That's where it starts becoming quite interesting, because you could be making profit off a downtrend, which is interesting, which is more difficult with when you're doing spot. Now, this being said, those are overall the benefits. There are also drawbacks, because there is a higher risk of generating major loss and getting liquidated, and we'll talk about that just after that. When you're in a trend reversal, if the price is moving in the opposite direction of where you wanted it to go and where your trade was positive, actually you could end up very quickly losing more, very quickly, the invested amount. And that is what we call liquidation, which is the risk, and I'll talk about that later. And, other thing that you need to know about this is that, the leverage has a cost. It is what we call the funding fee. It is called the funding fee. Funding fee can be positive, which means that it is the users who are in a long position are paying for the users who are in a short position. And when it is negative, it's the other way around. So basically, it gets funded automatically by the distribution of people who are long and people who are short. So it is something you need to be careful about. Just keep in mind, if you're longing, you need a positive funding. Otherwise, you will get charged and you'll be paying for the ones who are shorting a given asset. Another aspect to this and drawbacks is, well, you're trading 10 times more. So basically, your fees are going to be much more, are going to be higher compared to if you were just trading $100, which is normal. You're trading a bigger amount. So it is basically giving you a much bigger percentage. The other thing is that futures fees percentage and spot trading percentage usually are a bit different. They're higher on the exchanges for the users, depending on the VIP level that you're in. So just be careful about that. There are great benefits. You can make more profit, but you can also lose more and lose your funds. So it can be quite critical. Now, when we're talking about futures trading, there are different things. There are two main concepts, which are margin and leverage. Margin trading is typically going to allow users to borrow some funds. So you borrow some funds, and you're going to trade with those funds that you borrowed. When you're using margin trading, there are going to be funds that you are borrowing on which you need to pay interest to the users who are providing you with the funds. That is mainly on the margin trading aspect. So it allows you basically to be able to trade with a much bigger volume amount of dollars, which allows you to easily have bigger profits with a small invested amount. There is an increased risk because whenever you're trading with leverage, it's going to impact the overall returns that you're going to have, and you can very quickly get in a situation where you've lost all your margin, so you've lost all of your basic funds, and that is when you get liquidated. The other, so that's margin, and we're not going to talk about that, but exchanges do provide margin trading. what we're going to be using with the Bitsgap bots is going to be leverage trading. So leverage trading, it allows you to multiply your exposure to the market. So basically, you're going to come in with $100 and say, I'm going to trade a leverage of 10 on that. And so basically taking your $100, it's going to multiply that by 10. So basically your trade size becomes 1,000. Leverage is going to use borrowed funds, but that is going to be done in the background and funded by the funding rate, as we said before. So this makes your trades larger. It's going to give you the power to maximize any small price movement, because if you're trading something with a 10% leverage, every 1% movement that you have on an asset is going to be transformed in a 10% gain on your initial investment. So it is quite interesting. You can really play the smaller moves. This allows you, from a pure benefit perspective, having exponential gains. You can have smaller investment. You can have larger control on how you're investing and what your plays are. This really requires you to have a good understanding of the trends and be able to identify the small trend movements, the reversals, things like that. And there are drawbacks. Nothing is perfect in the trading world. So it can generate exponential gains. You can also have steep losses. And so that is where it becomes quite critical to have a better understanding of what you're doing compared to spot trading, where in spot trading, even if a given asset price just drops 50%, doesn't really matter. But if you're doing leverage trading on a given asset and that asset drops 50%, you can be in big trouble depending on the leverage level. If you have a leverage of 10, 50% drops mean 500%, which is huge, and you'll never get there because you get liquidated as soon as you hit minus 100%. So this has much less margin for error from a new user perspective. So whether you're leaning towards margin trading from a pure on the exchange perspective, or trying to automate with automated bots such as the Bitsgap future bots, and we'll look into that just afterward. It's really the choice is going to be yours. It's about what is your trading style, what is your risk tolerance, how much are you going to risk the invested assets, and understanding how the market moves, which is overall the market knowledge. So these are going to be quite critical in futures trading. When we talk about futures, there's also another aspect about the margin management. Margin, look at it as it's the money that you're putting it, or the assets that you're putting it, which are acting as a guarantee. For example, when you go and take a loan at a bank, they're going to say, well, you need to bring me some guarantee. And then you come in and say, well, I've got a car, it's worth 10,000, and I'm going to put that in a guarantee. And as soon as you default on your payment, they're going to foreclose that, which means they're going to sell the car and refund basically the loan that you did. So they're not going to lose any money. From your perspective, it's going to be a bit, you need to do that management from your own side. So when we are talking about margin modes, is that let's imagine you have a set of assets that you want to provide as margin, and you want to do futures trading on 3 or 4 different assets. Either you can say, I'm going to use cross margin, which is sharing this guarantee among all the trades that you have open on futures, which increases, it increases your risk of overall liquidation, because as you're allocating a pool of resources to a set of trades, if one of the trades really goes bad, it can, just kill your margin level and it can kill your whole account. So there is a risk in using cross margin. When you're using, there are also benefits from a user perspective. You don't have to do individual trade margin management. It also allows you to do hedging. For example, if you're doing cross margin on all your trades, you can have use long and short at the same time. From a pure trading perspective, it allows you to hedge the positions and avoid to completely clear out your margin. So when you have many futures trades, sometimes it's just easier to manage it in cross, but taking the risk that if one of the trade goes wrong, it's going to blow out everything. So there is a risk of total liquidation. Then there is the isolated mode. That is, I would say, my preferred, and that's just because I prefer using isolated mode, and it gives me better control on the funds that I'm allocating to a given trade. It also allows you to keep the trade limited. If something goes wrong, that trade itself can be closed and will get liquidated, but will not impact the other trades or the remaining margin. So there is, I would say, a better predictability on how much loss you're going to have. So that is something which can be interesting. And of course, there are drawbacks, which is you need to have some manual management on the margin allocated. It requires a bit more monitoring. So these are two different modes, and I would say, basically there is no one is better than the other. There is no one is going to work better than the other. It's just about risk management. How are you managing your risk of the individual trades? So it's going to be based on your strategy or the strategy that you're trying to apply on a multiple traded assets. So what is the one that's going to suit the best to you, or what is the mode that fits the best to your strategy, or the one that you're the most comfortable? There is no real good or bad in this case. It's just going to depend on what you think is the best or where you feel the most comfortable. So these cross and isolated margin management are going to be critical, and we'll look into this when we start getting into the configuration. So with all this, there's also this liquidation. This liquidation concept does not exist in spot trading because the funds belong to you, the assets belong to you. You're not borrowing any asset. If the asset price drops 90%, you don't really care. You can still hold the asset. It has lost value, but it doesn't really matter. In case of leverage trading, you're basically trading with funds that have been borrowed from other users or the exchange. And understand that the users who are lending you their assets to trade with leverage or the exchange platform are not accepting any loss. They will never be losing their money. So basically, if you are trading with $100 and you're trading it with 10 times an X10 on leverage, basically you're trading with $1,000. So $100, which is yours, and $1,000 that have been, and basically it would be 1,100. But okay, basically you're playing around with money that you do not own. So if price goes up 1%, that's going to generate a 10% profit on your $10, which would be 1% of $1,000, which is $10. So that is great. Now, if price goes down and it's going to go down 1%, you would be losing 10%. So losing $10. That is still unrealized. But as soon as your price, if your price keeps on dropping and you hit the 10% marker, which is minus 10% from the price at which you entered, basically you would be at minus 10% multiplied by your leverage, which is 10x in our case. You end up at 100% and you have liquidated your margin, which is $100, which was your guarantee. So now that you have lost your $100, you get liquidated because we need to send, the exchange needs to send back the funds to either the users or the platform. Before you cannot lose, actually the thing is that you lose money that you don't have. So in this case, when you're trading with futures, there is all this concept of margin management where you can add additional funds if you see that your price is going downwards. So if you see your price is going down 5%, you can add another 100 as a guarantee, which allows you basically to cover any further loss or any further downtrend and avoid being liquidated during those spikes that you see, really the tails of the candles where you just see a spike and then price moves in the opposite direction. So it just avoids getting liquidated on these quick money grabs that most of the asset plays, the way it plays out. So we talked about basically leverage, how leverage works. We talked about margin and leverage, what those mean. We talked about margin modes. That is quite interesting. And we talked about liquidation. Once you have these basic concepts, we're going to start look into the different tools that are available. Now, the Bitsgap platform is going to provide you with 2 automated trading bots that are designed to automate the trading in the futures market. They use a systematic approach to manage positions, automatically DCA prices, things like that. And that's going to be automated with an automated take profit that's going to be either on level, percentage gain, or going to be on indicators, and we'll look into that. And that's going to be quite interesting. In here, when we're talking about the futures DCA bot, that's purely a DCA strategy, a pure DCA strategy. So you enter with a given percentage of your investment, and then you're going to place additional buy orders, which are going to be on the downside, which is going to increase your position as the price is dropping. This allows you to basically reduce your DCA price being the overall average cost at which you're buying your overall asset. So as you're moving through these DCA lines, your average buy price is going down, which allows you to DCA your price in a much more smarter way. This can be done on a manual operation perspective, but it's going to be automated in our case, and it will automatically take profit as soon as it hits a +1, +2, +3% on that. So DCA strategy applied, you can use it both ways. So it can be either long or short. You could be betting or that an asset price is going to go down, which is what we call short, or betting on the fact that the price is going to go up. So take profit as the price moves up. So both can be used, and we'll look into that just in a few minutes. One thing to keep in mind is that overall on futures trading, even if your exchange allows you to have leverages, high leverages such as 25x, 50x, 100x, even 125x, etc., the Bitsgap platform is going to limit you from at a 10x maximum. That's just because we are concerned about security of user funds, and we don't want to put in excessive risk on the users using these type of tools. If you are interested in trading higher than a 10x leverage, then I would recommend you go directly on the exchange platform and do your trading manually over there. That's one way of looking at it. But I would, higher leverages, as the leverage goes higher, higher the risk. And so it all depends on how much, what is your risk tolerance and how do you want to play the game. If it's a speculative game, well, taking a risk on a small amount can be interesting with a potential of higher gains, but you could lose that. So it is in the strategy of having short-term, mid-term, and long-term bots that are going to apply on a stable income strategy, we want to minimize the risks. So for that, I think, when we are getting to a leverage of 10x, it's more than enough. So the first one is going to be the DCA bot, and that we're going to look in that. This is just pure DCA strategy where you have an entry price and then you have additional DCA orders that are going to allow you to minimize your average cost and take profit as soon as it's going to hit a level, which is typically a percentage from your DCA price. The second one is going to be the futures combo bot. The combo bot is a combination of a DCA bot, as you can see, the green lines here, and a grid strategy. It's a hybrid bot that is going to apply and buy new assets with these DCA orders as it is going down. And then on the selling side, it's going to apply a grid strategy perspective, a grid strategy, which is going to sell off small amounts as the price is rising. So it's not one take profit, it's going to be multiple take profits that are going to be broken out. In the case of combo bot, as you are buying through this DCA, these DCA orders, you're just adding to your position, an existing position. And this position is going to grow and the average buy price is going to reduce. But, it's going to be reduced by less than where your price is dropping. So there will be a range in the middle between the first sell and the first sell, a red line, and the first buy. There will be a range where the range will be bigger compared to a typical grid bot. But that is just because you're on futures, you're not trading with individual assets. It's an overall position to which you are adding or removing. These bots have different type of features, and we'll just look into that. Again, this is capped 100%, and so we'll be looking into that. So let's try to dig into that. So let me get to my trading UI. Okay, here we are. So I'm going to be using a demo platform for this just to show you how to get around. So what we are interested in is the bots. First thing you need to do is actually have an exchange. And in our case, you can use, depending on the exchange that you're using there, not all the exchanges provide futures on this, but the ones that do provide is Binance Future, Bitsgap, KuCoin, OKEx, and Bybit. So you need to have access to those sites and have the futures account validated on that, and of course have funds on that. If you have one of these future accounts connected, then you can move to your bot settings. And let me just, if we take DCA bot, and I'm going to start a new bot. Okay, So we'll start with the first one, which is the DCA bot. And this is pretty close to traditional DCA. So first thing you need to do is select your exchange on which you're working. The way this presents itself is a very simple, simplified UI. First thing you're going to be doing is defining, the type of, in our case, it's going to automatically select isolated mode for the leverage. You will set the level that you want. It can go from a 1x, which doesn't actually bring any value compared to a spot trading. But as soon as you start getting into 2x to 10x, that is where it's going to get interested. I would always recommend, start small. Start with a 2 or 3x leverage so you get familiar with it and start using it. So let's set it at 5. Okay, it was already set at 5. And what we're going to do next is get into the bot settings. So by default, you can see there are quick setups here, or you can use the strategies as provided on the left, depending, whether you want to select a strategy, an existing strategy that would have yielded a good performance in the past. For example, if I take Melania, this asset has been on the downtrend for some time. It is hitting its bottom. So actually, we would have done great if we had shorted it at the beginning, and we would have made great profit, and now we would be the good time to exit. So I'm not going to select this coin on a short. What I would be interested is now that it is hitting this bottom down, and we're going to do some analysis on that. We can just take a stochastic, look at it daily. It's not doing really, there isn't much actually on this. It is still in the update. Let's look at the RSI. How is the RSI doing? Okay. RSI is sitting around the 50. It is bouncing off 50. So it is typically going to have a new high. And we could, if we're looking at this, basically, let me get this correctly. Our next level would be somewhere over here, 1.5. That is where we would be existing. There would be some sort of range here. What we want to test is this level. So first we need to go over here, which would be around 147. And then if we keeping up, because we can expect over here at least having 3 bounces here before it starts reverting. But we have started, we are in a reversal phase. We have marked a higher low. Now we need to confirm with a higher high on this one. So it should be moving upwards. And there's going to be one major level up here, which is going to act as resistance. So, okay. So, okay, let me close this. Remove. There we go. Okay. So when we are setting up a bot here, so what I'm going to say is select first my direction. Okay, I'm going to select the direction, and then I'm going to be moving in on a shorter perspective, time frame perspective, and start doing some basic settings here. So if we look into the details of how things have been moving, so what we want to do in these manual adjustments is, first thing, how much am I going to be investing on this? So basically in my balance, I have 5,000. Let's say I want to play around with $1,000 here, which is going to be 20% of my overall funds. So that is good. Now, in a DCA strategy, you're going to split the orders between an initial investment, which is buying now at a given price, and in my case, I'm going to do a 300-700 distribution, which is 1/3 as initial and keeping 2/3 as DCA orders, which allows me to build the security that I want to do on this. Of course, the same DCA concepts apply to this, and we did it on our DCA webinar. We did look into the details of how we would set this up. Either you'd be using your investment 500-500, which is 50-50, a ratio of 1:1 between initial and averaging orders. That's a way of looking at things. What the impact that you're going to have on from a pure DCA perspective is this DCA price. If what this is telling you that if you hit all these DCA orders, this is actually the DCA price that you would be getting. This would be your average buy price. So here it is sitting around 1401. Okay. Now, if we distribute that, let's say we put in 300 here and 700 here. Okay. Then your average buy price, if you bought everything, would be lower. So as you're moving investment from base to DCA, it's going to lower your DCA buy price. That is still interesting. And that is what you want to do. And this is your risk management. You can also add additional lines as you're moving through. And this is typically going to be on different levels that you want to hit. In our case, we're pretty much hitting the bottom of this trend. So I'm not expecting much more downside to this because we've already eaten up, and this level has been acting as a support level. We can see it hit it once, twice, 3 times, 4 times. So it seems to be holding from a pure support level perspective. We just need to have a higher high here, which would be marking. But if the price does move downwards, then this distribution is what I'm going to be looking at. If I want to cover more space, and this space is going to be as well as the price, and we hit our cycles on this, we will have the same spacing. So we can, just tweak this a bit. Let's say I don't want 0.5, but I want to have a minimal of 1%. This gives me much more space. And this time I'm really hitting the downside of this spike that happened on the candle here. So, well, once we're going to set this up, I'm going to invest 300. That is going to be my basic investment. And then I'm going to select, how many ranges, how many DCA orders, what is the grid that I want. We can also play around with the amount multiplier, that is 1313, which are the typical values used in these type of trades. If you move the step multiplier to 2, that is what we would, 2 and 2 is what we call a pure martingale strategy. But that is something that works, definitely, but it is much less effective from a pure trading perspective. From experience and from past trading data, 1-3 is the sweet spot. Now, on the step multiplier, if you want to play with the amount multiplier and the step multiplier is the one that is going to allow you to adjust the range that you're going to be working. I find 1-3 to 1-4, 1-4-5, 1-5 to be the interesting place to play around with this. And that's really going to be dependent on the asset. Okay, so you select the range, you select how you want it to move. We can reduce this a bit, 0.7. We can add additional steps. Every time you're going to add another step, it's going to reevaluate the whole distribution of the assets. And if you are going to play around with the amount multiplier, this is also going to define how it's going to change the way funds are going to be distributed on these orders. So usually from a starting perspective, I would keep it at 1.3 from an amount multiplier and step multiplier and just move on from there. The way you're going to be doing the initial start also is going to be important. You can decide whether you're doing a limit order. So when you're starting, you're placing a limit order, and then you have to wait for the exchange to hit that price at that price. And every time you restart, or you can be using market orders. Market order is buy at any price at which the asset is now. So this is maker and taker. There are different fees applied to this, depending on your choice. It doesn't really matter. You can also define how you're going to be starting the bot. The bot can start immediately, and it's just going to run its cycle. As soon as it takes profit, it's going to start the next cycle. Or you could say, well, every time I want it to complete, I want to use an RSI 15, which is my favorite level for RSI 15 minutes, and it's going to tell you, in the last 30 days, it had 45 signals. So which means that basically we hit a low RSI. If I move it to 15 minutes, let me remove this, add the RSI. There we go. Let's put it in favorite. Okay. So basically RSI 15 minutes, I'm on the 15 minutes, and I've got RSI here. So what this is going to tell you is that during the past month, we can go back to early stage of the months, but on the 15-minute level, we did cross this, and we did hit this 20% on the RSI, 20 on the RSI 45 times. So if I had started the bot somewhere over here, it would have done its initial buy on this drop over here. If not this one, it would have been the next one. So these are just going to be the markers at which things are going to happen. So if you take profit, next time it's going to start is when the RSI is going to hit the lower. So it's just a way of taking time before entering the market, and entering the market when it has been oversold on the 15-minute time frame. It's just a way. Depending on the experience or the users or the trading styles, if you start looking at 5 minutes, this one hit 3 times more. It's going to have much more occurrences on how many times did it hit this lower trigger, and how many times the bot would have started. But it is, the lower you go on the time frame, the more signals you get, and the less confirmed they are from a trend perspective. So I find the good balance between 15 minutes and the one which is 1 hour is ideal. But I would say, if from a pure DCA bot that you want the bot to be working over and over, this is an interesting bot. 15 minutes is quite interesting. Then what you can do is you can combine that with an additional one. And what I do is combine it to a stochastic. RSI and stochastic, both are linked actually, but you can use RSI or stochastic, one or the other. Stochastic is the one that I prefer actually, so I use this one. Okay. So we've set our number of DCA orders, the averaging step that we have, the multipliers, price multipliers, how we are going to start, what is our direction, what is our margin mode. Okay, and then we're going to say, well, what is going to be my take profit level. So I've got this DCA set, and I'm going to say, well, every time I hit a 3% profit, okay, 3% profit from my DCA price, I'm going to take that profit, okay? And then that cycle is complete, and the next cycle would start where, depending on our entry that we defined earlier, the bot is going to restart a cycle. We can also define, additional. Do we want it as a regular take profit? That is a take profit which is set as a limit order on the exchange, or we could having trailing. In that case, there is no order set on the exchange, but Bitsgap is going to monitor the price. It's going to set in two different price points, which is the TTP trigger and the TTP trailing. What this is going to do is basically, I've got the 3% and I've got a trailing set at, let's just put it at 1%, okay? So, which means that I need my trailing TTP, trailing take profit, which is here, which is not active for the moment. I will need to go up 1% from that 3%, hit the trigger. Once I hit the trigger, that is actually going to activate my trailing take profit. From there on, this trailing take profit, which is going to be set as a limit order on the market, and it will be following the price. If price just keeps on going upwards, for example, if I come up here, I hit my trailing take profit, and the price just keeps on having these higher and higher ups, and is never retracing more than 1% that I defined as the price deviation, well, my trailing take profit will just keep moving up. And as soon as my price retraces 1%, it will hit the active take profit. So having a trailing take profit allows you to better build your potential if you are in a trending asset. And if you are in an uptrend, it will just keep moving up. But it will take only profit on the amount that you have acquired, which is your initial buy and any additional DCA orders that you got. And it will take profit, then it closes, and next cycle starts. You can also define so either regular or having a trailing one. You can also define regular. You can either choose a limit order or a market order, maker or taker, again, different fees on the exchanges, different mechanism of execution. If you are in a trailing, that is market, because you cannot execute on a limit order when you're retracing, especially if you're coming down from a price, you need to execute. But that is not a guaranteed price, because if the price is steeply dropping, you could execute a market order at 145.8, but it would only execute on the exchange at a lower price. So your risk is a bit higher. You have less control on the price at which it is being executed. And then, of course, you can define finally a stop loss. A stop loss would be let me get that out. There we go. Typically, it is placed below the last of your DCA orders. You don't want to stop loss before executing all your DCA orders. That is going to just close out the deal, and that's what it says. It's a stop loss. And that would, when you're doing on a stop loss price change, let's say if the price drops 15%, that is where I want my stop loss. I want to exit my trade because I'm going to lose much more than that. And price change 15% with 5x, that is typically going to take us 515. That's going to take us around a 75% loss on our investment. Do not forget, we're running with a 5x leverage here. I'm investing 1,000. So from an exchange perspective, we're using 5,000. So if I'm losing 75% of 1,000, that's $750 that I'm losing while I'm trading with 500, with 1,000. Okay. Okay. So we can, of course, we can backtest that. From a backtesting perspective, it's going to be a bit negative, which is normal. We've been in a downtrend. What we are expecting here is a reversal and something that starts going up. That's why we are going long. That is why the backtesting is actually not good, because we've been on a downtrend. Don't forget, DCA is quite interesting as we're trading trends. So we want to trade an uptrend on this one. And so we're just going to continue and start it. Once you've done this, we've got our settings all set up. We're going to do a start bot and we'll see what happens. So in here, the way this is going to work once the bot is started, it's going to execute the first buy order. We're still waiting on it. We can look into the details. If we start getting into the details, we can look at the bot orders. For the moment, there are no orders, so it has not started yet. We're expecting it. It should be. Oh, it's waiting because we said it was by indicator signal. That's why. So it's not going to start right now. What it's going to do is wait for the base order by indicator signal. And this is what we set up from a configuration perspective. If we change that, we'll just set it to immediately. We can modify it, go back in the bot settings. I want to start it immediately. Okay, confirm. Now I've changed the configuration to start automatically as immediately. And so now the bot has started. So what it did its initial purchase here. And we have DCA or DCA orders which are set below, and we'll just let it run. For the moment, there is no executed take profits for the moment. We just have the base order. We did pay a fee on that, and we've got some standing by DCA orders that are just sitting there for it to run. Now, one interesting thing here is, how do I manage my performance? And one of the things that's going to be quite interesting, not interesting, but critical to monitor is your margin level, which is given here. Typically, your margin level is going to give you the liquidation price. So in our case here, we can see that we did set a stop loss, which is below the liquidation price. So what does that mean? That means that we set a stop loss at a price which is lower than the liquidation price. That is not good, because that means that you, at the liquidation price, you got liquidated and you were done. So two things you can do here is either move the liquidation price below the stop loss or increase your stop loss price. So what we can do is we can go back in here. Where is it? Modify bot, risk management. No, I want my stop loss, and I want to move this to -11. Where would that take us? Okay, let's put it even -10. Okay, continue, confirm. So this is one way of doing it, where you set a stop loss and say, well, if price drops at this level, I'm just going to close my deal, get out of it, and I'm not losing everything. I'm not getting liquidated. The other way to do this would be to lower your liquidation price. So that can be done by adding additional margin. When you're looking, and you just have to click this small button here or go to both actions, adjust margin. Both ways to access this. When you're looking at adjusted margin, it's going to tell you there was some margin that was allocated automatically, which is the size of your initial order. What you could do is, and this margin is going to increase as you're buying through your DCA orders, but you could also decide saying, well, I want to put in an additional $50 and we can watch the liquidation price. Can we see it here? No, let me get down here. My current liquidation price sits at 1114, and if I add $50, it's going to say, well, your price is going to go down to 1097. And I can confirm that or not. If I confirm it, it's going to adjust my liquidation price. That means that I'm putting more funds into it. Again, to the example of borrowing money from the bank, you have set your car as a guarantee, and you also have a motorcycle. And now what you're doing is saying, well, I'm going to put the motorcycle also. So there is much more space to move around in your trade. It gives you more flexibility, but it's putting at risk your car and your motorcycle. So that's where stop loss is going to be important, not losing everything, and you can reduce this liquidation price. And that is done through managing your assigned margin. You can either add or remove margin, depending on how your trade is moving along. If you see that there is more downtrend to come, you can add more margin. That is adding security. If you see that the trend is reversing, going back upwards, then that means that you have more space, you're more secure about the deal. So you can start removing margin so that it can be used elsewhere. So it's just about how you're moving your securities around and how much money you're putting in from a security perspective. So now, as you can see, the percent of risk on this is at 7.2. Usually I try to keep it around 3-4. And that is really going to, on these type of accounts, it's going to be about how much reserves you have for trading security. On spot trading, you don't need this security funds that are going to help you secure your investment or your trade. It is very important when you're doing with futures. There are standard rules around trading on futures, where if you've got $5,000 on your futures account, you're not putting at risk the whole of it because you don't have any security left. So the basic rule around trading on futures is trade 5 to 10% of your portfolio. That is your maximum. 90% of your funds on futures are just there to secure your trades and avoid losing the 10%. So there is this ratio of 1 to 10 that you need to be very careful about. If you have, as I said, $5,000 on a futures account, you don't want those $5,000 in a trade. You just want $1,000 and using the $4,000 as security, because there is going to be a lot of volatility on that. Higher the leverage, higher the risk, lower the ratio of your investment. So that is how we play this overall game. Okay, so we can add another, we have 350, let's add 350, and that should give us more than enough space around this. So see, price can drop to 0.7 without any problem. And I'll just let it run, and we'll come back in a few days and watch this, how this goes. So, and this is, trading with futures bot, the DCA bot. Now, when we start the other type of bot, which is the combo bot, it's going to be presenting itself in a bit different because the strategy that is used is a bit different. This one is a hybrid bot, as I said. It can be either long or short. Long or short, it is, I'm going to just select, let me take Sol. I got USDT, yes. Okay. Okay, I'm going to put in 500, and we're going to go through some manual logistics. Okay, so in this bot, this is going to be, it's going to be buying as it is dropping through your grid lines in green, and it will be selling when it hits the red lines. So dropping the green line is going to create an open space here. It is different from a pure grid bot, where as you're dropping through the green line, it's automatically adding sell lines. And you can do that on spot because you can buy a given amount of a given asset. It does not impact your overall buy price from a pure position perspective. In the case of futures, when you're adding new assets to an existing position, if that position is still negative, which means your current price is lower from your DCA price, if you reduce that position, you're losing money, which is different, where it is totally different when you're trading spot trading, where you can buy one sol and sell one sol, and keeping 100 sol that you bought at a much higher price. It does not impact. In the case of spot, you're just buying and selling small amount of assets. In futures, you're buying and selling small amount of assets, but that are only to build your short or long position. And if your long position is losing and you reduce your short position, I sell off a portion, you're losing money. So the concepts of grid trading in spot and futures are totally different. The way we are going to set this up is we'll be using our support and resistance areas. So what we need to do is look at this. We're going to be looking at Sol, and we can say, well, I want my grid to be somewhere around here, okay? Because we've been hitting this support area over here, which is a critical one. We're going to hold on it, and I'm expecting it to move much higher, okay? So the distribution that you want to have on this is going to be pretty flexible. You can add some extra on there and say, well, we may be hitting some lows before having a moving up. So I want something to be in this range. When we're looking, and I'm playing around with the high levels, which is from a graphical perspective, just setting the range on which I want to trade, this is automatically going to tell me, what I need to do. It's saying, well, I started with an initial investment of 500, but that's not enough because the price distribution and the minimum amount that are defined on the exchange require me to have more funds than the 500. So either I have to increase it to 510 or reduce the number of grids. So if I go down to 24, this solves the problem. So now I'm just working with 24 grid lines and a percentage of 3%, but that is quite big. This is going to be in a much longer term perspective. So that this one is typically going to be trading, as you saw, this move here to the down was pretty much 2 months. So I'm expecting it to move up in 2 months' time, and with a 3% per, 3% grid step, that is great. Now I could be looking at it from a different perspective, saying, well, what I want to do is on a much shorter term, I want to play it, short term. What would my grid look like, or a midterm? If I take a midterm, let's put it like this. So this is going to be, I'm on the daily candle perspective. This is going to be having daily coverage with a 0.6. Let's put it to a 1% with 20 grids. Okay, why not? And this would be, the range, the ATR that we were talking about, the average true range. We can see that there are movements of around 10% in a day. So that could be quite interesting. So we can set it there. And this one is automatically going to trail up. Okay, that's what I'm interested. This is looking from a long perspective. So the way this is going to work, I'm going to start at this price, which is around 190. If the price drops until 177, it's going to be buying additional, and so increasing my position. But I still need to go through these selling lines up to 204 before I've sold off all the assets that I acquired. So I acquired initially here, bought some additional here, and then I'm going to sell off portions, 10% every time if I've got 10 lines, 10% as I'm going through. Once I've completed my sell-off, it's going to restart a new cycle. It's going to rebuild this hybrid grid at a higher price, which is where I will be sitting. So from a long perspective, this is very interesting. Goes up, comes down, buys as it is going through the grid, and as it is selling, once it has completed its sells, it's going to sit there and open a new session with the same configuration, same investment amount, same number of grids, with the same grid span, but just the grid is moved above. And that's going to repeat the process. And it's going to just keep on executing on that as it goes. What are the settings? We can also define if we want a stop loss on that one. Stop loss is automatically going to trail with the grid. As soon as you close your order and move to the next sequence, the next cycle, which is going to recreate a full grid, automatically your stop loss will be moved from the same percentage as the grid has moved. So your stop loss will automatically be following your grid, and just that is a way of saying, well, for every cycle I accept 10% of loss, and then start a new cycle. And of course, you can define also on take profit, which is saying, well, when I hit this given price, my bot is done. It has stopped trading. And that way, if you're in a move, which is somewhere like this, you know that it's going to move like this. Basically, you've done DCA, 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 sell, 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 DCA, 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 sell, 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 new cycle, DCA, sell, new cycle, DCA, sell, take profit, shut down, and you're done. So this is how you would follow a grid. When you're doing a short, which is the other way around, well, your take profit and your stop loss are inversed, and the grid is going to be going down. And that would be typically if you're looking at something which is going to go downtrend. And that is where you would be running a short bot. It would execute the same mechanism on a downtrend. Okay, let's start it. Let's see what it's going to go. So this one has been doing something. So let me go back to this. Oopsie. Okay, let's see what it's doing. Well, it's far away from its trailing take profit, etc. And you would see your results coming in here as we're going through it. I don't have any data on here for the moment. Nope, as we have not executed any data here. But what this would pretty much look like is this was what it would look like. So basically, you would see all your profit as you're generating profit. Every take profit would show up here. You can, start going through daily, monthly, weekly, etc. And the analytics part where it will be showing you combo bot, which ones are short, which ones are long, the future bots. It's going to show you the distribution of the whole performance. So these are things that you can use for monitoring. Just be cautious about, basically your liquidation levels and how you're allocating your funds onto that. This is something which is going to be quite critical to monitor, especially in futures trading. Okay. So we did have several questions from users, and these are things that we did actually post before. And so the typical questions that come in from users is how to manage liquidation price and minimize risk. That's what we were talking about earlier. It's about how you allocate your margin. And this is what we were showing in the margin section, where you can add or remove margin. Let me get back to that here. You can either add or remove margin to reduce your risk percentage. And this is what is going to allow you to play with the liquidation price. The golden rule is really about 1 to 3% of take profit. Be careful, higher the ratio, higher the leverage, higher the margin is needed to secure your deal, which is normal because you're borrowing more and more funds. So managing liquidation price is done using these adjust margin. That's what it's going to do. There was another question concerning what is the leverage cost and impact on P&L. When we are talking about the leverage cost in futures, not in margin, but in futures trading, there is what we call a funding rate. Funding rate is how this funding gets financed. Funding rate is, you can find the funding rate. Do I have it somewhere over here? Let me see if I can bring that up. Do I have it here? Funding rate is somewhere. So the funding golden ratio, let me see if I have open interest, volume, funding rate, fund history, futures data. It's going to, there should be some funding rate in here. Well, there's a funding rate. A funding rate is typically, where is my funding rate? There we go. There we go. Funding rate. So funding rate can be either positive or negative. Okay. Positive or negative. When it is positive, basically you're not paying to buy any funds or to borrow the funds. Okay. The way this works with the funding rate, it's a mechanism that was put in place by the exchanges, is that basically on any trade you've got users who are long in their positions and users who are short in their positions. And what they said what they came up as a mechanism is saying we'll create a funding rate, and depending on the funding rate, when the funding rate is positive, it's the users who are in long positions are going to pay for the users who are in short positions. And when the funding rate is negative, it's the users in short positions who are going to pay for the users in long positions. So it's a balanced way of funding. Either you're paying for the others or others are paying for you. So it's always interesting and it's just a way to incentivize users to go towards long or short side. The idea is this is the mechanism that they have found on futures to be able to bring the price and have the price always aligned with the spot price. There are two different platforms, and the way to align the futures price to the spot price is by incentivizing the users who are trading to the opposite direction of the difference of where the future price is sitting. So this funding rate, it was set in place to incentivize users, and this is what helps place the trades in the correct direction. So the funding rate is something that's going to be important and that you need to keep in mind. The impact on P&L, basically the funding rate, either you're getting paid for borrowing funds or you're paying funds. So if you're in the opposite direction of the funding rate, then it's going to be additional cost that is going to be taken from your basically from your margins. So basically it's impacting your overall P&L. So always try to be in the correct way. And that is one of the strategies that many traders use, is always being on the side of the funding rate. How to add liquidity to my trade. This one takes us back to the, let me bring up my, yeah, this was correct. So the liquidity, how do I add liquidity to my trade? This comes back to how to manage liquidation price and manage and balance the risk side. So it is about all managing your overall margin. So same as above. Question after that was, how do I maximize profits? Well, maximizing profits, if you're in a given trend, then basically you're going to be making profits. Now, in order to maximize the profits, what you'll be interested in is about spotting the trend. Let me bring that up. I think I have it somewhere here. Yeah, here we go. So spotting the trend, because what you want to do is clearly identify and be able to have identified entry and exit points, especially on futures, because this is clearly a trend following bottom, because you're either long or short, so you're following a trend. But you also need to start at the lowest point possible if you're long, and the highest point possible if you're shorting something. So in order to do that, you have to have a good understanding of trends. What are the key trend reversal points, and optimizing your entry and exit. There are many indicators on this. You can use typical support and resistance levels that identify which are the demands and the supply levels. Typically, a support is going to be a level where there's a lot of demand, so you know that there could be a reversal at there. And when there is supply, it's the other way around. A lot of orders selling out, a lot of sell orders. So you know that that would be impacting the price towards downwards. So support and resistance, having MACD indicators, moving averages, RSI, stochastic, all those are technical indicators, and these are available also on the platform, you do not need to go in any external tool. Where is it? Let me bring it up here. Okay. You've got these technicals when you start getting into, where are my technicals? Let's get out of here. But let's take Sol. Where are my technicals? Oh, it's on trading. Yeah, right. It's on trading. So Sol, I had to switch to the trading tab, and then I get to my technicals, click on more details, and here I've got all the technicals. And these are, very typical or the standard indicators that are on the on crypto assets. Overall, they're the same as stock market, etc. And you can use these to identify, what is the trend. If you've got a strong selling side, that means that price is going to go down and price is going to be moving downwards. So analyzing these technicals is really important when you're looking at ideal entry points. And what you want to spot is when things are reverting. It's typically when things are going to change. So either you can use the technicals, you can use typically the RSI. Stochastic is a quite interesting one, because this one really marks, either overwhelming market or exhaustion of sells. And these tend to mark good areas. And the higher the period, so we can only have 1 day here, but if you're using trading view, for example, let me bring up trading view. There we go. If we are using trading view, then we can use spans which are much higher. It could be daily, it could be a weekly perspective, and these are going to identify high level of exhaustions or overheating markets. So in our case, when we're really on these downsides, stochastic, for example, over here, this is stochastic, I think. Yeah, this one is stochastic. This one is going to show you when it's hitting once, twice, 3 times. This is an ideal point for starting. This is a good entry point. And then you just run the wave as it is going through until it comes back down. And then that's, when you start hitting 1, 2, 3 up here, that is your exit point. And those would be the optimal entry and exit points. So this is maximizing your profits is really going to be about identifying these reversals and identifying, what are the best entry and exit areas and where you want to be sitting. So that's how you maximize your profit. So last question was, when is it okay to look into futures and when is it not? Okay, where are my user questions? There we go. Okay, so as we've talked about it, futures are great. It allows you to maximize your profit on clear trends, on clear identified trends. And optimal way of doing that is having entry on key reversal of your trends. That's great. There you've got different ways of doing that. Identifying your trend, fear and greed index can be a good thing. Funding rate reversal, your basically your overall moving averages reversal, things like that. That is going to be great. And then you just need to understand from which trend are you switching to which trend. If you're moving from a downtrend to an uptrend, then you want to go long. if you are moving from a downtrend to an uptrend, well, downtrend from uptrend, you're going long, and if you're moving from an uptrend to a downtrend, you're going short. But if you are sitting in a ranging or a range bound type of thing, that's going to be much more effective for grid bots, because the price is not really moving enough to have this full range covered, and that can be a bit difficult, especially on futures. So what you want to do is really be on a clearly identified trends and spot the entry point. That's where you want to start getting into this. Okay, what else? Quick link to a few resources. We've talked about that several times. There are two different guides that I wanted to show you guys, which are really interesting. These two marked as resources. Those are two sessions. Let me bring it up. Which one do I want? This one. Let's take this. See this. And if we go to YouTube, there are two videos that you really need to be looking at. Let me go down to DCA bots. I think it's this one, part 3 and part 4. Maximizing Bitsgap combo bot for tutor tradings and mastering Bitsgap DCA bot setup and strategy guide. These part 3 and part 4 are really amazing tools. They explain in details how the bot is going to work, what is the logic used, how to adjust it. There are a lot of details in here. It's going to give you how the setup works, things like that. This is really interesting. So just go through these two videos. Those are going to be marked here, combo bot, DCA bot. You've also got distance to the oopsie. Let me where is it? Let me just close this. Stop. Okay. There we go. And we want PPT view. Okay. So these two resources are really great. I would also recommend going through the knowledge base. Knowledge base is really if we go back to the knowledge base itself, is full of articles that are going to be the feedback, not the feedback. Let me duplicate this tab. Let me go to okay. The knowledge base is full of resources on all the bots, by the way. There are some general questions. There are AI assistant, how this works. You've got the DCA futures bot, DCA bot. There are a lot of things in here which are going to be very interesting in understanding how it works. Links to the videos, links to setup guides, step-by-step guide. There's a lot of information here that can help you navigating this. So it's really quite interesting. Okay. So that was pretty much what I wanted to share with you guys around futures and how Bitsgap bots can help you run futures. We looked into the details and the basics of what future trading is. We looked into the details of the different bots. Hopefully this video will be helpful for you guys. Do not hesitate to comment and get back to us, and see you soon for a next webinar. Thank you.